Revolving credits versus offset accounts. What are they and what's the difference? Well, many Kiwis use these types of mortgages to save thousands on their mortgage, paying less interest to the bank. But so many of you guys still ask, well, what are they and how do they actually work? Well, that's what you're going to learn in today's video, including the 4 questions that you must ask yourself to see whether you should use a revolving credit or an offset mortgage. So make sure you stick around to the end so you make the right decision for you. I'm Ed, an economist here at Opes Partners, and this is Property Now. Revolving credits and offset accounts are very similar. There's not a major difference. They achieve the same outcome, which is to save interest on your mortgage. Think about it this way. Let's say you've got a $500,000 mortgage and you fix $450K of that at the 1-year rate today, and that's about 7.3%. But then you still have this $50,000 portion of your home loan. Well, you might set that up as a revolving credit or an offset. That will be on a floating rate, which is usually more expensive. So you might say to me, well, Ed, why would I choose a more expensive interest rate? Won't that just cost me more money? Well, not necessarily, and it all comes down to this unique feature of revolving credits and offsets. You see, with a revolving credit, part of that mortgage, that $50,000, it acts as a big overdraft. So you owe $50,000, but then you might have $10K saved for a holiday or $5K as an emergency fund. Maybe you've got another $5K you've been saving for buying a new car. You collect up all of that money and you put it into your revolving credit. Now you're not paying interest on the full $50K, you're only paying interest on $30K instead. Now, over a year, that could save you up to $1,000 in interest compared to if you just left that money in another account. Now, offsets, they are very similar, but instead of one account, you've got multiple accounts. So you've got your load, and that's your $50K of mortgage debt on a floating rate. But with an offset, instead of putting money into this load account like a revolving credit, you link that load to all of your other bank accounts. So you've got your $10K holiday fund in one account, $5K emergency savings in another account, then your normal spending account. All of that money cancels out some of the interest you pay on your home loan. And you might be thinking, well, this sounds great. Why doesn't everyone do this if I'm going to save interest on my mortgage? Well, it is great, but the issue is that most people just don't understand how they work. And there are some other differences we'll go through, but the big difference is this. With a revolving credit, you keep all your money in one account like a big overdraft. With offsets, you keep your money in lots of different accounts. So, which is right for you? There are 4 questions to ask yourself so you make the right decision. The first question is, how do you like to manage your money? Do you like it all in one account, or do you like to separate it out into different buckets? Well, to use a revolving credit, you put all your spare cash into one account like an overdraft. So all that money, it's mixed in together, and you've got to remember, well, which is the $5K for holidays and which is the $2K for car repairs. With an offset, you separate your money out into different buckets or different accounts. I once met with an investor who said, I don't want to use a revolving credit because I need to have my money in different accounts because that's how my brain works. Well, if that's you, you're going to want to use an offset account because you can do that. If you don't care and you just say, oh, I can have all of my money in one account, it doesn't make a difference, then a revolving credit could be the right one for you. The second question is, which bank are you with? Well, all big banks offer revolving credits. So no matter which bank your mortgage is with, you can probably get one. But not every bank will give you an offset. Right now, only BNZ, Westpac, and Kiwibank do offset mortgages. If you're an investor buying through a company or trust, it gets even harder. If that's you, only Westpac will give you an offset mortgage. So, if you're with ANZ, ASB, or TSB, your only option is to use a revolving credit. But if you're with BNZ, Kiwibank, Westpac, you've got a choice. That does mean if you're desperate to get an offset mortgage, you may need to change banks. And in fact, one of our mortgage advisors at Opes Mortgages, they've recently helped an investor move to BNZ specifically to get an offset mortgage. And it was actually a pretty cool story. The mum had some cash in her bank because she'd just sold a property. And they set it up so that mum's money would cancel out or offset some of the daughter's mortgage. So it saves the daughter money on her mortgage, but the cash is still in mum's bank account. So for those guys, it was actually worth switching banks just to get that benefit. And if you like learning about property in this really simple way, hit the subscribe button. We release new videos every Monday and Wednesday. The next question is one of the most important, so don't skip past this. It's, what are you trying to do? Are you trying to decrease your mortgage repayments, or are you trying to pay off your mortgage faster? Now, the big benefit of a revolving credit is you can have what's called a non-reducing limit. So you've got a 50K revolving credit limit, and it stays like that. When you put money in, you save on interest, so you pay less money to the bank and you get to keep more of it, and you can do whatever you like with that extra money. Offsets are different. So it's like a normal home loan and you have to pay it off. And here is the big fish hook that most investors get caught with. With BNZ, if you have an offset, your repayment might be $100 a week for that part of the mortgage, and let's say half of that is going to be interest. Well, even if you have fully cancelled out or offset your interest costs, you still have to pay the full $100 a week. They charge you the same amount. Now, the good news is that extra repayment goes towards paying off your debt faster, but it doesn't give you more cash in the short term. So, if you are trying to decrease your repayment and have more cash flow, go for the revolving credit. If you want to pay off your mortgage as fast as possible, then an offset may be the right fit for you. The last question is, are you okay with being in debt? Now, with a revolving credit, it almost always looks like you're in debt. So if you've got a 50K revolving credit limit and you put 20K in, when you log into your bank app, it will look like you have 30K of debt, like a big overdraft. Now, some people like this. It makes them think, I can't go out and spend money, and so they spend less money, they make better financial decisions. But some people don't like that, because when they go in, they think, where'd all my money go? And that can make them a bit stressed. So if that's you, you might like to use an offset where the same amount of money looks like you've got cash in the bank. Now, let's be really real. It's exactly the same. It's just a different way of looking at it. But if you're the sort of person who would get stressed out by seeing that they're 30K in debt in their transactional account, then you might like to go for an offset. Just make sure that you don't think, wow, I've got 20K, so I'm going to go buy a jet ski. And if you want help figuring out what's right for you and setting these up, talk to our team at Opes Mortgages. They help regular Kiwis get their mortgages sorted.